Hello, this is Jeff Evans taking you through the level 4 financial statements of limited companies, and it's the sample assessment, the sample one on the AT website. I'll do this in a series of videos. I'm going to do question 1.1 and 1.2 first, and then 1.6, which is the consolidation question, and then the ratios I'll tackle in separate videos. And then those in the middle, to do the standards again, I'll do that one as well. So this one, it said it's a cash flow question. It said you've been asked to prepare statements of cash flows and statements of changes in equity for Chicago Limited for year ending 31st of December 20x1. The most relevant statement of profit and loss and statements of financial position, as we can see, are given here. So we've got the profit loss account Chicago here, and all the statements of financial position, which we got through clicking these. So we're going to do draft reconciliation of profit before tax to net cash from operating activities for Chicago Limited for year ending 31st of December 20x1. So why do we do this? Okay, because what we want to see in relation to this organisation, so what were the profit or loss from their normal operating activities? So for example, this here, the profit loss account, we've got that the profit from continuing operations is 12,854. Okay, but within that, we've got profit on disposal, we've got a depreciation charge in the expenses, we've also got finance costs for this one as well. So we want to really know, so what were our what was the profit or loss of our normal operating activities? So I tend to say at this point, so imagine you've got a sandwich shop. You might even rent it out upstairs, one of the rooms upstairs, but anyway. So for your sandwich shop, you want to know how much money are you making from just selling your sandwiches, okay? If you sell one of your vans, yeah, and make a profit on that van, that's not part of your normal operating activities. So we need to take it out, okay? Similarly, to do with depreciation charges. So depreciation is an accounting adjustment. So again, I do tend to say, if you buy a van for £10,000 at the beginning of the year, and it's depreciated, say 10%, so there's £1,000. So the carrying value at the end of the year is £9,000. Well, it didn't cost you £9,000, did it? It cost you £10,000, because again, that depreciation is what we call a non-cash item. It's an adjustment. Okay, so what we do with this one, and it tells you here, it says we're going to draft the reconciliation of profit before tax to net cash from operating activities. And again, I have seen these in previous examples where it's got profit from operations, so you just have to bear that in mind. So with profit before tax, okay, we're going to make an adjustment for the finance costs because they're interest payments, again, not part of your normal operating activities, so we add those back. But if you get profit from operations, you don't need to do the adjustment, okay? But this one, profit before tax. So let's have a look. So profit before tax we're given is 16,400, and then we're going to make the adjustments, and this is always the same, okay? If you remember the format, you can't go wrong. So the first thing you're going to do is you give a depreciation. So again, depreciation is a non-cash item, so you're going to add it back. So therefore, 4,992. Profit on disposal, well, we made a profit of 139,000 on the profit on disposal of PPE. Again, that's not part of your normal operating activity, so I'm going to take it off. Equally, if that said loss on disposal, we would add it back, okay? So as if it never happened. Because again, not part of your normal operating activities or selling sandwiches or whatever it might be. Excuse me. We've then got, again, because this is profit before tax, we've now got the finance costs. So those finance costs, we're going to add them back because again, that's interest payments and not part of your selling of your sandwiches or whatever the case may be. So we're going to add back those finance costs, which is 3,200. Okay, again, the format is always the same. And then let's have a look at our adjustments for our inventory. So what's happened to our stock? So it's either an outflow of cash or an inflow of cash. So did we buy some more inventory or not? So I've got a calculator here just to show you. So let's just move this to one side. So let's have a look. So we started off with 18,000, that's million, but £18,608 worth of inventory. Well, then it's gone up to 22,732. So therefore, we've bought more inventory, haven't more stock. So that's an outflow of cash. So 22,732 minus what we started with from last year, 18,608. So therefore, we've spent 4,124 extra on inventory, or 4,124,000. So that's an outflow of cash. What about your trade receivables again? So your trade receivables, let's have a look. So your trade receivables owed yet 15,162, but now they owe you 18,251. So they've bought more goods off you, but they've not paid you, have they? So that's negative, isn't it? Thinking it the other way, I was just saying, so if your trade receivables have gone down, what have they done? So if that was the other way, so let's say that was 2,000 XO. So the owed us 18,251, and now the owe us 15,162. That means that they would have paid us, don't they? Okay, so for this one, again, I always say state the obvious, or think of the obvious. If your trade receivables goes down, it means they've paid you. If it goes up, it means they've not paid you. So it'll be an outflow. So again, so for this one, so 22,732 minus 18,608. Also, I'm doing inventories again, aren't I? So 18,251 minus 15,162 is 3,089. Okay, so again, that is a minus because again, they have not paid us for the goods that we've sold them. Same with payables. So what's happened to our trade payables? So this time, our suppliers, okay, again, think about it logically. So if your trade payables goes down, what have you done? It means you've paid them. So that'd be an outflow of cash, wouldn't it? Whereas this one is where we've got the goods, but we're not yet paid for it. So look, so 12,316 was what we owed our suppliers, and now we owe them 14,712. So we've not paid them. So that's a positive. Okay. So therefore, once you put all your figures in, you've got your profit before tax, add your depreciation, take off your profit on disposal, so on and so forth. So that should give you your cash generated by operations of 19,636. Okay. As far as your tax paid is concerned, and again, I tend to do this on a tier count on the board because it's far easier, because you've got your tax liability. So follow it through for me. So draw your tier count. Do tax payable, because you've got some adjustments. So what it says in your financial statements might not be what you actually paid, because you might have got some adjustments of where you've overpaid one year or underpaid one year. Because remember that when you submit your tax return, you know, there might be some adjustments that need to be made. Okay, so tier count. So you go to the balance carried down. So let's have a look. So your balance carried down so far as your tax liability is concerned. Balance brought down, sorry. So your balance brought down, obviously on the credit side, is 4120. Your balance carried down on the debit side is 3270. Okay, so remember that. So balance brought down on the credit side, balance carried down on the debit side, and then you're going to put your profit and loss account figure on the debit side, okay? Because that's what your charge is for your profits in the year. So therefore, you'll see your profit and loss account figure is 3516. So we go to the debit side. So on the debit side now, sorry, on the credit side. So on the credit side, you should have 4120 plus your tax charge for the year from your profit and loss account 3546 gives you 7666. On the debit side, you've got your balance carried down, which is 3270. Okay, so remember you go to balance it to 7666. So your balancing figure is what you've actually paid. So that's your bank figure. So in this example, it's 4396. So I'll say that again. So draw your T account, balance brought down on the credit side 4120. Balance carried down on the debit side, 3270. Your profit loss account figure goes on the credit side of your T account, and your a charge to your profit loss account is 3546. So again, on the credit side, and then you just balance it up. So therefore, your actual tax paid is 4396. Okay. So again, so you need to bear that in mind. I really stress the importance of that. Okay. Because again, you need to get to know it. And then we've got the interest paid now. So that interest paid, those finance costs that we added back before, we're now going to take off. Okay, so therefore, we've now got our net cash from operating activities. So 19,636 minus the tax paid, which is 4396. The interest paid is minus 3,200. Which give you a net cash from operating activities of 12,040. So we're going to take that figure and take it to the statement of cash flows. Okay, just move this out of the way for you. So that's where we're starting off. So 12,040. So then we're going to look at our investing activities. So what are our investing activities? So we've got the proceeds on the disposal of PPE. It tells us here, property, plant and equipment, the carrying value of 543,000 was sold in the year. So the carrying value is 543,000, yeah, and we made a profit on disposal of 139. So all we're doing is we've got the carrying amount, 543, add the profit, 139, means that the total proceeds are 682, okay? And again, if you got loss of disposal, it means you would take it off the carrying amount, wouldn't you? All right. And then we got purchase of PPE, and again, I prefer to do it on the T accounts, but I'll show you on here. So let's have a look. So what were your purchase of PPE? It tells us in here as well that land was revalued upwards during the year of 7 million. So therefore, let's have a look at our property, plant and equipment. So we've got our balance brought down on the debit side, which is 31962. So that's your PP at the start of the year. So balance brought down on your debit side, 3192. On your credit side, you're going to put the depreciation charge. So that depreciation charge of 4992. So you'll see the working, so minus 4992. You've also got the asset that you dispose of, the PPE. You dispose of, the carrying value of that was 543. So again, on the credit side of the T account. And then you're going to add back that revaluation of 7 million. So that will be on the debit side of the T account, which is 7,000. Okay. So again, when I prefer to do it on the board on the T account, so debit, balance brought down 3192, balance carried down on the credit side of 7736. And then your balancing figure would be your total additions of PPE. So again, the way the workings are, you'll see all your credits are coming off, aren't they? And your debit is being added. So therefore, let's go through it again. So PPE at the start of the year was 3192. Depreciation charge, 4192. The carrying amount of the asset that disposed of was 543. The revaluation was 7,007,000. And then your PP at the end of the year, so minus 77,736. And that will give you your total additions of 44,309. So that's what you spent on property, plant and equipment. So an outflow of cash. So therefore, your net cash from operating activities is minus 43627. So 682 minus 44309 gives you minus 4327. So then your bank loans, did you make any bank loans? So you started off with 18,000, excuse me, or 18 million, and it's now gone up to 40 million. So you've borrowed an extra 22 million, haven't you? So 22,000 you'll see there. So we've borrowed 22, so just the difference between the two, it's increased, hasn't it? So 22,000. You've got dividends paid, because it gives you in the question, or in the profit loss account there. It tells you in the notes. So a dividend of 4 million was paid during the year. So therefore, we're going to take off. So from the dividends paid is 4 million. So from the financing activities. And then you got your proceeds of your share issue. So if you look at your shares, so you had 20,000 in 20XO, and that's gone up to 30,000. So you've raised an extra 10. I know it's million, but an extra 10,000 in share capital. Your share premium has gone from 6,270 to 9,340. So again, so you work out the difference between them. So we had 10,000 we've raised in share capital. Share premium has gone up to 9,340 from 6,270. So we've raised an extra 3,070, or 3 million. So then add the 10,000, which that's where you get. So you've actually raised your proceeds from your share issue is 13,070. Okay. So what's the net cash from our financing activities? So we've got 22,000 minus 4. Then we got 13,070 from our proceeds of our shares, which means the net cash from our financing activities is 31,070. So you can now go to your net cash from operating activities is 12,040 minus your net cash from invested activities, which is minus, I'll do it for you so you can see. So we go, so 12,040. The minus 43,627, or 3,627, and then plus 31,070, which means we've got a, see, our net increase or decrease in cash equivalents. So it's a net decrease in cash and cash equivalents of 517. Okay, you can now check to see if it's right, because you're just going to take the figures directly from this statement of financial position. So look, so your cash and cash equivalent at the beginning of the year, see? So your beginning of the year, you had 372,000. So there's your 372. At the end of the year, it's gone down to an overdraft of 145. Okay, so there's your minus 145. So therefore, you can double check that to make sure it's right. So you started off with 372,000, didn't you? So you had started off with 372, but you ended up with minus 145, didn't you? So if you had £372,000 and it's gone into the bank, so you've got overdrawn by 145,000, you've spent an awful lot of money. So let's add the 145. So 517, you see? So it's gone down, isn't it? So that's where the 517. So you know by just checking the information that's given to you that that 517, if you know it's right, isn't it? So you put those figures in first if you want, and then hopefully if that balances, right? So it's a good way of checking to make sure you've got your figures correct. All right. Right. So we've done that. And the next thing we're going to do are the statements of changes in equity. And this one is relatively straightforward. So let me show you, because all you're doing is taking the information that you've got from your statements of financial position, figures, so on and so forth. So watch. So all we do now with those adjustments, you see. So your share capital at the beginning of the year was 20,000. Share capital at the end of the year is 30,000. So therefore, that's those calculations we did before, isn't it? So we've raised 10,000 through issuing share capital. Share premium, 6,270 at the beginning of the year. At the end of the year, 9,340. And again, we've got, so next year, sorry. So you've raised an extra 3,070,000 through share premium. We've got the 7,000 or the 7 million, the other comprehensive income from the revaluation of the land. So therefore, the revaluation surplus is now 7,000. Okay. And then we've got our retained earnings. So again, go to your retained earnings. At the beginning of 2000 XO is 5398. Your retained earnings at 2001 is 14,252. See, I've just put the figures in. And then you've got your profit loss or your total comprehensive income. So go to your P&L. So your profit from continuing operations is 12,854. Take off your dividends, because that's your retained earnings, your opening retained earnings, plus any profits that you've got, minus any dividends that have been paid, will give you your balancing figure at the end of the year, okay? And they're just your balancing figures at the end of your notice. So you should have your total equity. So the start of the year was 31668, wasn't it? It should be there somewhere. There, see, 31168. And at the end of the year, 60592. So it all tallies up. Right. Okay, so that's question 1 and question 2 for statement of cash flow. So you do know in this in the AT exam, you're either going to get cash flow or a profit loss account balance sheet to do it. Again, with statement of changes in equity. I'll do that in separate videos. For now, what I want to take you through is 1.6, which is the consolidation question. Okay, so consolidated statement of financial position. So let's have a look at the question. So this is Houston, who's the parent company. So Texas is the parent company, and Houston, which is the subsidiary company. So let's have a look. So on the 1st of January 20X1, Texas PLC acquired 80% of the issued share capital and voting rights of Houston for $420,000. At that date, Houston had issued share capital of $240,000 and 20,000 retained earnings of 20,000. Okay, so this is at acquisition. The fair value of the non-current assets of Houston on that date were 100,000 more than the carrying amount. The revaluation has not been recorded in the books of Houston, so ignore the effect of depreciation. So we know we're going to need to add 100,000 to the property, plant and equipment, so debit property, plant and equipment, and then we're going to credit the other comprehensive income of 100,000. Excuse me. The directors of Texas PLC have concluded that goodwill arising on the acquisition of Houston has been impaired by £25,000. So we'll do the impairment of goodwill later. And it also says, including the trade receivables of Texas, the trade payables of Houston is an intercompany balance of £6,000. So there's been an intercompany transaction between the two. So we're going to take it off the trade receivables of Texas, and we're going to take it off the trade payables of Houston. So we're going to reduce it by 6,000. So we add them together. So the trade payables are going to take 6,000 off. Same with the trade receivables, we'll take 6,000 off. Because again, consolidation is really just a case, a lot of the times you just add in line by line, the assets and the liabilities. Obviously, there's a few adjustments that we'll go through now, but that's where we start off. So the first thing I'm going to do the goodwill. I always tend to do goodwill, non-controlling interest and retained earnings, so I'll do it in that order. Okay, so the first thing we've got is consideration of £420,000. That's the investment in Houston, see? That 420,000, it tells us that in the notes. So what did they buy for that? So the net assets acquired at the time of acquisition. So what I did, I put the net assets in first, okay? Because it's easier to do, I always feel. Because at time of acquisition, the share capital was 240,000 and 20,000 was the retained earnings, but you also had that revaluation of 100,000. So that's 360 are the net assets acquired, okay? So of that, what have the non-controlling interest got? So therefore, so we got your net assets acquired now is £360,000, yeah? And the non-controlling interest, so 20% of that, the subsidiary has still got control of. So times 0.2 gives you 72,000. Okay, so the spending, so Texas is spending £420,000. The non-controlling interest has still got £72,000, and the net assets acquired at acquisition were 360,000. So 420 plus the 72. So again, that's what we got. So they paid 420 for 80%. 20% is still with the non-controlling interest. So there's your 72. And the net assets acquired were 360,000. So minus 360 means the goodwill would have been 132,000. Okay. But because we're going to impair it, we're going to take off the 25. So minus 25 equals 107. So we've got 107 is the goodwill. So I'm going to type that straight into the consolidated statement of financial position. Okay. Next I'm going to do, because I was going to this mindset, I've done goodwill, and now we're going to do the non-controlling interest. Okay. Because it's exactly the same, with the exception of you're now going to take into account the retained earnings at the end of the year, because this is what is the non-controlling interest at the end of the year. So let me show you. So you've still got 240,000, which were the share capital. Retained earnings, I'll come back to that in a minute. So retained earnings now, rather than at the beginning of the year at acquisition, it's what are your retained earnings at the end of the year. So retained earnings for Houston now are 60,000, wasn't it? So it was 20,000 at acquisition, and it's gone up to 60,000 at the end of the year. Okay. So therefore, when you come to do retained earnings or to work out the non-controlling interest, you've got the 240. So the only difference you're going to make from this here, from that 360, is the additional increase in the retained earnings. So again, watch 240 plus 100, so the revaluation. But now we're going to add the retained earnings, which is at the end of the year, which is 400,000. Okay, so retained earnings at the end of the year. So that's the share capital. So that is the net assets at the end of the year, which is 400,000. Of that, they're going to retain 20%. Yeah, because 80% to the parent, 20% to the non-controlling interest. So times 0.2 equals 80. So therefore, I put that in as well. So I always do this first. So we do the non-controlling interest is 80 because it's easier for you to draw out. So when you draw it out, it's very similar to what you did for goodwill, apart from retained earnings will be 60 and not 20. Okay. Now we're going to do retained earnings. So retained earnings is basically 100% of the parent. So what retained earnings of Texas is 172,000. Okay, and then how much of that increase in retained earnings of Houston is attributable to Texas? So what we do, retained earnings at the end of the year for Houston is 60,000, and at the beginning of the year it was 20,000. So therefore, since they acquired the subsidiary, it's increased their retained earnings by 40,000. Okay, how much of that goes to the parent company? So they've got 80%. So times 0.8 equals 32. Okay, so that's where we get the 32,000 so far as the retained earnings is concerned. So the retained earnings attributable to the parent. So 172, which is the 100% of the parent. So 172 of Texas, 32,000 of Houston's, it's attributable to the Texas, and then we take off the goodwill. So remember to take off the goodwill from the retained earnings. So that's what we do. So as far as goodwill is concerned, impairment, we credit the goodwill. Yep. So we credit goodwill in relation to goodwill is an asset, isn't it? So therefore, we also debit the retained earnings to reduce it. Okay, so 172 plus 32 minus the impairment is 179. So we've done those first. So we've done the goodwill, which is 107. We've done the non-controlling interest, which is 80. And we've also done the retained earnings, which is 179. Okay. So now the property, plant and equipment. So property, plant and equipment was 1520 plus 241, which is where 1761 comes in. So let me show you. So 1520 plus 241 equals, and then we've got the 100 extra. So the land has been revalued, hasn't it? Yeah. We don't say the land on the question. So the fair value of the non-current asset has been valued by 100,000. So there's 1861. Okay, so 1861 is your property, plant and equipment. So therefore your non-current assets are 1968. Your inventories, so literally your inventories are 238 plus 64. So you just add them line by line. 238 plus 64 equals, so there's your 302. Your trade receivables, so remember the note here, trade receivables is 126 plus 30, which is 156. But there's an intercompany transaction, wasn't there? So we need to take off the 6, which is where you get the 150 from. So 150 trade receivables. Cash and cash equivalents, just add them together. 39 and 18 is 57, which gives you current assets of 509, plus your non-current assets, which gives you 2477. Now your share capital, well, this is where the students tend to struggle. So those share capital of Houston, we've already accounted for that 240 and the 60. We accounted for when we did the goodwill and non-controlling interest, didn't we? So all we do when it comes to the consolidated statements of financial position, it's the share capital of the parent. So 1800. We've already done retained earnings of the group. We've also done non-controlling interest, so that gives us total equity of 2059. Your non-current liabilities are again, so 234 plus 19. So your non-current liabilities are loans, 253. Your trade payables, so we said before, so 103 plus 26 is 129, minus the 6, because the intercompany transaction gives us 123. Taxation, simply add them together again, 34 and 8 is 42, give you 165, and that's it in relation to this particular question. So good luck. So practice, practice, practice. Okay, so I've done 1.1 and 1.2, and I've also done 1.6. So that's it for this video. And again, I'll do the 1.1, so 1.7 and 1.8, which are the questions to do with, I'll show you, are the questions to do with the ratios. Okay. And the 1.8 is also to do ratios, but interpretation of the ratios. And I'll do that separately. Okay, thank you very much.